Okay, so we're going to analyze Mr. DIY. So, so Mr. DIY is also a retail business, which makes it relatively easy. Like retail is the easiest sector to analyze, right, from a mainstream sector perspective. But this one has a bit of nuances, so it's kind of interesting. So let's have a look. So okay, right, from 2017 to 2020, it's grown
Wow.
from. So and also normally what was this? What's this? Okay, so you see this is normally what I do when I'm analyzing. So we've got 2017, 2018, 2019, 2020. Okay. Now it's June, right? Yeah, let's just ignore 2021. So so this one is million. Okay, wow, that's cool. So you will notice something about me, right? I normally just um but I normally just take uh the first four numbers. So if someone is giving me like nine or seven numbers, right, which is normally what happens if this one is expressed in thousands, I will just
Right.
ignore the back numbers, even if you normally people would roll it, right? So that makes it a lot easier to key in, because at the end of the day, it's about margin of safety, right?
Yeah.
So like I don't really go and worry whether my thing is rounded up or down properly. Okay, so we got PVT. Oh, we got EBITDA also, not bad. Okay, do you understand what is the significance of EBITDA compared to um, compared to PBT?
Uh, Not really. I mean, I only know that like it's sort of the value that acquirers look at.
Okay, so the reason people use EBITDA, or in EV EBITDA, right, more accurately, is because um, what happened? Yeah, normally I like to make it pretty. So the reason why most people use EV EBITDA is in certain sectors, right, is because it's more appropriate for certain sectors to use EV EBITDA rather than PE, um, to as an apples to apples comparison across companies, right? The reason being that let's say utility sector, some companies are very highly leveraged, some companies are not. So what happens when you're highly leveraged? First of all, um, you have what do you call it? First of all, you have a lot of interest payments, right? So
Yep.
you have, and also, yeah, you also be using that leverage to buy a lot of capital assets. So it's very capital intensive, which means you have a lot of depreciation. So and another thing is that because you have high interest payments, you get to deduct that from your tax accounting, right? So
Mm-hmm.
if you are trying to use net profit as an apples to apples comparison between companies in the utility sector, obviously somebody with high leverage is going to have higher earnings than someone with lower leverage, right? From a PE
Yep.
kind of perspective. So you use EV EBITDA to get an operating earnings kind of perspective. It's like a halfway step of valuation where you are um, where you get an apples to apples comparison, and then whoever is using the EV EBITDA figure will go further on to do their own adjustments, right? To get that EVE kind of or even a PE kind of valuation. The reason why we use EVE as opposed to PE is because one day you are going to have to repay the debt also, right? You can't refinance to perpetuity, right? So
Mm.
you got to deduct your earnings by that much, right? By the amount of debt that you borrowed. That's the mistake I used to make. I used to think about companies which can refinance debt in terms of PE ratios, right? So the idea being that they can refinance to perpetuity, so the only cost is bankruptcy risk, right? But and interest expense. But obviously that's not the case. One day, 20 years down the road, you are still going to have to pay the debt back, right? In
Yeah.
full. So you need to use EVE and not PE. But quite strangely, nobody really talks about EVE, right, in the industry. They always talk about EV EBITDA, right? So okay, PBT, right? If someone gives you PAT, I normally give like ignore PBT because even when if normally tax doesn't really impact quite significantly, you can see the trend is quite similar, and even if it does, right? you are not a tax expert, so what insight are you going to get from analyzing tax, right? Or not? Sometimes I see analysts comment about, like oil and gas, they have different tax treatments because they have a PITA kind of thing, right? So PITA is the petroleum investment tax something where they have a profit sharing kind of thing with the government. So yeah, you're not a tax expert, so you ask all these, how much more insight are you gonna get, right? So I really, I normally just ignore tax. And the amount of time you save from ignoring 100 companies of tax is worth that one company that you might have missed something. Okay. So anyway, share price performance, yeah, you can see that. It's crazy. Okay. So very interesting. Okay. So right, you will learn about something. So you can see here SSSG, right? Retail company, right? Their metric that you need to observe can be boiled down to just one metric, which is SSSG. Sorry, two metrics, and churn. Right? I'm talking about non-e-commerce businesses, which Mr. DIY is still mostly not an e-commerce business. So why is SSG so important? Do you know what's SSSG?
Same store sales growth, right?
Correct. Yeah. So what is same-store sales growth? The underlying reality.
Uh,
Do you know?
Organic growth.
Correct. Correct. Absolutely correct. So the reason why we use same-store sales growth is because uh, it's basically a reflection of how many yeah, correct, like you said, organic growth, how much growth you have from existing customers, right? Existing stores, rather than including new stores, because obviously if you open new stores you are going to have more revenue, right? More sales. So you want to
Yeah.
understand what is the organic growth independent from opening new stores. So it is basically a catch-all kind of metric which analyzes the growth of the company, because you
Is there a standard way to calculate this?
sorry, is it a what?
Is there a standard way to calculate same store sales growth? Cause like you have different stores and they'll probably grow at different amounts. So like there's a standard, right?
uh, no, like you're just basically taking you're basically taking you're sorry you're basically taking the sales of the previous year, right, as the denominator, and the sales of the current year from the same stores as the numerator. So you just divide
Oh, I see.
this year from last year, right?
So you exclude any new stores, huh?
Yeah, you exclude any. So they would typically say we grow by the number of stores.
Right.
Let me see. Now you can see nah, not 305 to 406, 248 to 328. So you net them off. That's the new number of stores, right? So because this is an audited document, this number can be trusted, or at least can be trusted as much as you believe auditors, which it seems we are in short order right now. Yeah, so you can see that annual SSG is 4.4%. I don't know how good that is in a vacuum, but it seems good. Let me think. So there's actually a very good this one very good article about analyzing video companies. So let's try it. I'll send to you later. So why is this the same? Where's the part one? I cannot do it. Let me just why is there a part 2 but no part 1? Okay, never mind. So anyway, there's a part 1 also, right? These two articles are very very comprehensive as far as being an outside shareholder is concerned. So it tells you, right, what same store sales is, how it's calculated from the perspective of an insider as management, and what are the pitfalls of it, because with same store sales being such a complete metric, right, Hey, by the way, hold on. Hey, Dad, I'm recording now. I'm recording. So with same-store sales being such a complete metric, and to be fair, it's actually a very comprehensive metric, right? But it's not 100% perfect. It's probably at 90% perfect, which is as good as it gets already. But it does have some
Right.
weaknesses. So these two articles actually do explain, right? What are the what are the weaknesses of same-store sales using SSSG as a metric? And if you read this, you really get a almost 100% point of view as far as being an outside shareholder is concerned. Let me see if we can find that part one. But this guy hasn't really updated his blog for a long time already. What's this Jeff Bezos? Okay. Remember this one? Bill Ackman versus what do you call it? Bill Ackman versus Herbalife.
Huh.
Let me see. Retail. There's no retail here. That when I say I'm recording, it means it's recording you also. Yeah, the webcam is on. Okay. Never mind. So anyway, you can go read. I'll send it to you later. So, uh, white level products. Yeah. Okay. So you can see that they are doing their own brand kind of thing, right? It's increasing. So they are actually developing branding. So I think this is quite important. Okay, I'm gonna tell you something. I haven't actually looked at Mr. DIY before, right? So I'm as new to this as you. So white label products. So right? I've mentioned a lot that branded retail is the most powerful mode you can have in retail, right? You've read my in-nature articles, right?
Yeah.
So branded retail is really good, and if I can see that they're growing branded retail, that's good news, lah. And third party is following as a sales mix. Locally sourced products are increasing as sales mix. So, you know, these are all good items. So this one is from China, right? Definitely, right? You've been to Mr. DIY before, right? The stuff they sell
Yes.
is all like China junk. So they are moving to this, which means the margin trajectory is improving. So no, they even provide all these disclosures on the sub segment sales kind of thing. Here, right? So these are all very good disclosures. Like I do feel I feel very good when I see these kind of things. Hibiscus is another one that does very good annual report disclosures. Okay, inventory turnover days, right? So this is something I might want to look out for, right? There's a lot of inventory turnover. Okay, to be fair, this is not very high also, right? For retail, 150 days is like the standard, but it's not negative, right? Like Sheng Siong. So I'm not concerned, but I would found in my mental cabinet to try and look into it later. So right, let's just make a note of it. So what is it? Inventory turnovers. And the fact that they actually supply this to you and you don't need to go and calculate, right? It just makes your life so much easier, and you just feel a lot better about about them, lah. So right, you're also more likely to give them a good review. Right, it's the human element of it. So growing e-commerce, right? We're talking about it. So this is an example of a very good annual report with excellent disclosure practice. Okay, they talk about improving their warehouse facilities for future capacity. Right, they talk about their strategies to increase earnings. Their risk is basically boilerplate, so you can ignore them. So some companies actually go to the trouble of talking a lot about their risk, which is like Huat. Huat is a furniture manufacturer that in Malaysia that exports to the US and Canada. So they talk about macro risk. They talk about all the things that shareholders want to know, right? If you see a small cap company talk about macro, it's amazing. Okay, like you automatically can give them a good thumbs up already. Economic, social. Okay, this is alright. So we're past the MD&A.
how much do you pay attention to like for example they disclose about their e-commerce strategy, about expanding their warehouse capability.
A lot.
Like these are arguably like no-brainer moves to grow your business. Like
Yeah,
under what kind of do you pay attention to it?
so it depends on the quality of their disclosure lah, right? Um, let's go back. So before you can appreciate, you know, the usefulness of disclosure, you basically have to first understand. Oops, what's happening? You first have to understand from an external perspective, right? What are the relevant important parts of the sector? So you know, like you said, e-commerce is important because that's where the trend is going. So pandemic result on the shift, blah blah blah, right? E-commerce revenue rose to 17 million. So it's not really that amazing disclosure lah. You know what I mean? This is like, it's not boilerplate, but it's also not very insightful lah. So whereas like Huat, they really, I mean, they don't go into e-commerce, but they really go into the details of, like, you know, maybe it's a good idea. I can show you Huat's. Huat. I can give you an example of an annual report that I think is good. Okay. So you know, look at the management discussion. Um, this one, right? This one is all very helpful for someone who has never looked at this company before to get up to speed very quickly. You know what I mean? You don't need to go and read an industry primer and figure out what are the moving parts of a company. Right? Straight away they tell you already. So obviously it's not so relevant
Right.
to me right now because I've already looked at this company before. But you know, for someone like you who has never looked at this company before, right? You can straight away know that their manufacturing factories are in Vietnam, right? And the majority of their revenue is earned in North America, USA and Canada. And then business strategies, right? So they tell you that you want to enhance your position as a leading world class manufacturer. What's this? It means improve your brand equity lah, right? And then high quality innovative products. So the fact that you're talking about high quality products, as compared to if you don't talk about it at all, right? In the absence of talking about it, means that they actually are trying to improve their margins. It's more of a margin game than a low cost volume game, correct? And
Right.
they identify for you that they are an OEM. And actually they actually do mention somewhere, right, that they work closely with their distributor customers to identify what is important in the US market. So the domestic distributors in the US will have already done their market research, right, about, you know, how high a particular chair should be, what's the fashion trend in chairs or in beds at the time, right? Maybe some people like headboards, you know, some people like I don't know, elevated standing desks or something, right?
Mm.
Or maybe they want to use more environmentally friendly materials. So they work closely with them, which is, you know, obviously a competitive advantage compared to some guy who just spits out a million of the same thing, right? Particle board kind of thing that you can find on Shopee. So that gives you a margin leverage, a leverage to increase your margins, right? Then competitive
So
pricing. Yeah, sorry.
so what you're saying is not really about the presence of, you know, this kind of stuff like saying, oh, we want to basically increase our brand equity. It's more of, is there an absence of saying this kind of stuff, which
Correct.
tells you a lot more about the business.
Correct.
So these are sort of like no-brainer things that a business should be concentrating on. So if you see the business not really mentioning this, then it's sort of a red flag for you that, okay, these guys, they are not really trying to grow this business as much as they could.
I wouldn't say it's a red flag, right? I'm just, so there are actually two parts to it. The first part is like what you say, in the absence of it, right? Um, it's not no brainer, okay? In the absence of it, they could be doing it as well, But the fact that they actually like shine a spotlight on it, right, shows that that is exactly what they are doing, lah, correct or not? So it gives you more insight into what is management is thinking, what is their corporate strategy, right, as well as what is their culture, uh, their culture of approaching customers, right? So obviously here they are aiming at at least the mid range. The fact that they are even bothering to work with their customers, right, the distributors in the U.S. to try and identify what furniture customers in U.S. want, means that they are not playing a low cost game, right? So you can narrow down your research scope. You know what I mean? You can
Okay.
you can discount the fact that they are purely just like a mass market retail churn out kind of thing. So, which also means that they probably have some sort of competitive strength against a China factory, which tends to be this, boilerplate. Sorry, not boilerplate. This cookie cutter kind of business model, correct? So I wouldn't be so concerned that they're going to lose in terms of economies of scale, because they are not purely doing that, lah. You know what I mean?
Right, that makes sense.
Yeah, so having before you even analyze a company, it helps to understand the sector, right? Understand the industry landscape, so that it gives you more context to understand a company. But obviously, if your management, actually bothers to hold your hand, right, then that's like a huge plus, So right, competitive pricing, right? So aim to deliver. So when I read this, right, I fall in love with them, because it tells me exactly what I want to hear, right, in terms of being able to provide value for money to a customer. So when we shareholders analyze company, we look for ROE. When customers buy, they look for value for money. It's the same concept. It's basically the ROE, right, for a given amount of investment or cost, how much are you getting back? So for us, we are investing money and getting back money, cash on cash return. For a customer, they are investing money, but they're getting a particular non-monetary benefit, right?
Right.
So um, yeah. Hey, by the way, I'm hearing a bit of static in your background.
In
Uh,
my background,
yeah. Did you change the mic or something?
I did not change the mic.
Okay, it's alright, it's alright.
Mm.
So right, and then they want to provide good customer service. So you can see that these are guys who understand the need for how I say customer obsession. You know what I mean? The way Jeff Bezos described it, right? You are putting the customer before yourself. So rather than putting the shareholder before the customer, right? So the traditional concept is in running a business is you want to make money, right? So as a shareholder, you will want to squeeze the customer as hard as possible, lah. But because everybody has been doing that for centuries, the less intuitive strategy of putting a customer before yourself is actually becoming more competitive, right? Because by giving a customer more value than your competitors, you actually increase market share, and you can increase margins, and from there you actually earn more ROE, right? For a given amount of investment, you actually earn more sales. Am I right? So
Yeah.
putting a customer first before the shareholder is actually what I want to see, and the fact that they spell it out, right, it tells me that they actually understand this, and it aligns with my own personal culture in terms of how you should deal with customers. So right, it's like finding a friend, you know what I mean, as opposed to someone who is totally opposite with different principles, which is nothing wrong, right? I'm not saying I judge them, but the fact is that they're different, right, and you may not align on certain things. So right, and you can see that they actually talk about all the risks, right? US dollar risks, and they go into a lot of detail, right? They talk about for 75% US dollar sales, what's the impact, and like this is something you just don't see in small cap companies, right? Huat is their market cap is what, not even 400 million. So US furniture market, right? They talk about the US economy, and also how the housing market in US has been very hot, right? So, and they also give shareholders, like minority shareholders, insight into their what the market research is telling them on the ground. So it's like you are management, you know what I mean? Obviously they're not
Yeah.
going to bore you with a super long discussion, but right, it's impressive. It's very impressive, the fact they're doing this. Talk about revenue, talk about cost, right? They talk about the relationship, the dynamic, what relation, like, you know, you read all this, you already like done like one quarter of your research already, right? You don't need to go and key everything into a model and start guessing, right? Like they even tell you
Right.
the reason why it's a certain ratio, so this is good lah. And then, so I like this website a lot because it actually tells you, it's like a one-stop shop for all the information. Let me see. So like, so you can actually, if you are new to the company, you actually can go to the shareholders ownership. Yeah, so you can see that yeah, he owns 21%, right? 26%, and this guy owns 10%. So the top two guys already own like 40%. Right. Yeah, it's mostly owned by the owners lah. Oh, KFC is here. And then if I'm not wrong, Pangolin is also here. Pangolin. You know Pangolin, right? James Hay.
Don't know.
James Hay, he's a pretty famous guy in Singapore, value investor. So yeah, let me just show you his website since we're already talking about
I guess I live in the well.
Pangolin Asset Management. James Hay. So it's not these guys. There he is. I've actually met him before. He came to Malaysia once to listen to ourselves. This guy. So Pangolin is here. Wow, they redid their website. Okay. Pretty cool. Their old website was like super old. And they just started an aviation fund focused purely on this is James Hay, right? Focused purely on airlines, aviation sector. Just started like a few months back, so it's quite interesting. Then they poached this guy from Maybank, I think. No, from AirAsia. So this AirAsia, from before AirAsia, this guy used to be working in Maybank as their aviation analyst. And this guy is somebody. So anyway, let's get back to Mr. DIY.
Right.
So so the real meat of the, so here is where you start figuring out how they are bullshitting you, right? So they can talk to the sun about MD&A, but you got to verify lah, right? You don't just take their word for it lah. So so we've actually okay, good. So we can actually because of the revenue, so the typical ratios that I'm line items that I focus on is, you can see in my server dynamic one as well. So it's I want to know the cash flow. So okay, let's start with assets. So this one is income statement. So now let's talk about balance sheet. So so interesting thing to note is that
Right of use assets. So they are leasing their square footage.
correct. So 876,436. Not a lot of own, but you say it's a lot of lease. So this one is important in the context of accounting, right? You gotta understand how do you account for right of use assets so that you can start getting insight from it. Okay, so let's talk about PPE. RUA. And then, so you will notice that I don't key everything in, right? I just key in the stuff that I think are important. So obviously inventories is important. So receivables, right? You will sometimes find long-term receivables. Typically I ignore them because they are negligible compared to the current one. But if they are large, you might want to, like in AirAsia's case, you might want to go to the notes. You're going to find out what they actually are.
Right. So you're essentially just looking for those significant components. That's all.
Yeah, that's right. So borrowings, lease. So lease. So borrowings. So borrowings you might want to split it into short term and long term for obvious reasons. Then short term lease, long term lease, right? What else? Provision, tax. So tax I typically ignore lah. Payables. Okay, payables is important. Let's put the payables and then lastly equity. Okay. So I've explained to you why equity is important. We only have 2 years worth. Okay, let's just throw this away and focus on the 2 years. Oops, sorry. Alright, PPE 436354, RUA 79690. So one thing I've learned recently is to normally I don't double check my figures, right, because it takes a lot of time. But one thing
Yeah.
I've learned is that when you do your growth or cash flow ratios, right, you can see whether you have very like some sort of red flag kind of scenario where everything is the same number, right? So that one will tell you that you key something in wrong, or your formula is wrong. 876340. Hey, wait a second. This is the other way around. Okay, short term, long term. Wait short term, 24211. Long term, 26. Short term lease. Yeah, I can hear cars in the background.
Actually, there's an aircraft.
Oh, okay.
Is it?
Or maybe you can mute while you are not talking, but you can unmute and interrupt me anytime.
Okay.
Payables. Where's the payables? 11981. Okay. So, alright, so this is the balance sheet, and then you have your cash flow statement. Okay, so wait. Let's go back to this part. Okay, this is even worse. Can you unmute, because now I'm hearing like a ee sound, which is even more distracting.
Right.
Okay, so we have gross profit, right? We have cost of sales, and then so other operating is quite significant here, so we want to look into that. Let me see, EBITDA, it's after EBITDA. Other operating expenses. So then finance cost obviously is important, right? So finance costs, okay, let's key this in. Where are we? Cost of sales 1467 1311 1091. Oops, sorry. So you can actually see, right, it's not very time consuming to do all this even by yourself, right? You don't really need to like hire another analyst, but obviously if you can, it's better lah, right? So there are some people who think that modeling is a very time consuming work that can be used elsewhere. I don't think so lah. So you can see that okay, they have a merger reserve. Do you know why the merger reserve you can just deduct AIDs from share capital?
No.
No, okay. Let me think. It's a long story. Okay, typically what happens, right, is that your subsidiaries, right, or associates start to trade with each other, right? So like one subsidiary tries to acquire another company, And then what happens is that you know there may be a very confusing accounting at the group level because you know, let's say you acquire a company, okay, one subsidiary acquires another subsidiary with one ringgit share capital, but few million of book value, right? So that creates like a very large goodwill kind of figure, and it may not reflect a true and fair view of the situation, right? If you follow accounting rules, correct, right? So
Yeah.
like it's nothing to like it's not a problem with the management or the accountant in the company. And also you can't really blame the accounting standards body because you know nothing is perfect lah, right? So that's the trade-off we're going to make. So normally instead of like dumping all this to share capital and then pretending that your share capital is lower, right? What they do is that they will maintain the same level of share capital and then net off with a merger reserve. That's why they call it a reserve, right? A reserve simply means that there's no meaning to this line item. You know what I mean? It's just a reserve as a result of a merger because you don't want to like deduct this, net this off from this, and then give stakeholders a potentially inaccurate view of the company, of the capital base. So yeah, so cash flow statement, right? So your depreciation is important. Depreciation plus amortization. Yeah, do it. Yeah, let's just do separately. Amortization. No, let's put it together. So you understand the concept of depreciation in accounting, right?
Yeah, sort of spreading out capex over the period of its useful life so that you have an accurate view of what the long term are supposed to look like.
Correct. Okay, since the amortization is so small, I'm just going to ignore it. Let me see. Depreciation. Yeah, correct. So all these non-cash items you're adding back is actually sunk cost incurred long time ago. You know what I mean? So you know, you cannot say that I don't net off depreciation from OCF lah. You need to net it off to get FCF lah, right? It's an actual cost to the company, and then you look for, first of all, huge jumps from last year, or if you want, you can even look for like across many years, right? So typically this one will be like few years 5 years So right, if you notice a huge jump somewhere, you want to look into it, or a very large number relative to profit before tax, right? Like for instance, 45, right? Something that catches your eye. So everything else like this or like this, like you can just ignore it lah.
Right. So it's a big delta or big weightage lah.
Yeah. So I mean that's how I filter. So O3F before WC is 7, 8 and 666. And then so your WC itself has inventory, right? CF, receivables, CF, payables, right? So 218, 109, 640, 21. Oh, sorry. Alright, tax ignore that. Alright, then we get to OCF. 38503. So these guys you can do that. Okay. Then then your your FCF would be your OCF. FCF would be plus CF minus this stuff. Okay, wait, oh crap, they're all going to be like this. Crap. Okay, never mind. Can we remove the crap, they're all like that.
Maybe you copy paste the OCF before WC onto that cell. Oh, never mind. You solved it.
No, I didn't. Yeah, you're right. Okay. Why
Oh,
I still don't really understand this issue. What was the? I can't remember what was the shortcut. Never mind. Let's just do it manually. Yeah, good. Okay. So okay, so their PPE is large. So PP these purchases of this plus any intangible assets would be your capex, right? So your capex was 120,115, and then nothing else catches your eye. So dividends, that's important. 96,501.
oh, last year was 5 times larger.
So borrowings, cash flow, and these liability cash flows, typically you don't really care unless you're looking for liquidity reasons, right? Like in AirAsia's case or even Serba's case. Okay, so they had a huge equity issue here, right? So issue of equity 301. So this normally doesn't exist in most annual reports, but since it's here, we include it.
The IPO lah.
Yeah, and then I don't really care about borrowings normally, but you know we're already here, so let's just do it. What do we have? Borrowings. Term loans
Finance.
413,188. Let me see. This is 86. Oh, you have 212. Okay, let's just forget about this. It's not really important normally. Right? Sorry. Alright. Sorry. I'm used to it. Then yeah, that's pretty much it lah. Yeah, we already have cash up there, right? So you know, if you want to like specify investing cash flows and financing cash flows, you can, but I normally don't. So great. So you have this very beautiful model, and look, right, it's not very complicated, right? I mean, granted, it's just 2 years, but it's not like super long or like your, you know, your typical sell side model is like freaking complicated, complex, and like 2 pages long, right? Yeah. So, okay, hey, I'll go to the bathroom for a while. Let's continue.